Welcome to the latest Savings Guru podcast. I'm delighted to be joined by Tom Higham today, who is the Head of Business Development for Hargreaves Lansdown Active Savings. Welcome to the show, Tom.
Pleasure to be here.
Tell us a little bit more about the Hargreaves Lansdown Active Savings proposition. Obviously, Hargreaves Lansdown, such a strong name in the investment space. What made the firm kind of branch off into the cash savings market?
Probably started in around 2014. My boss, Stu Loudon, was tasked with looking at ways to better serve the cash needs of HR clients. So all of HR's investment accounts have the ability to hold cash, and the balance of that cash at any one time tends to sit between roughly 8 to 12% of HR's total assets under management. This money probably isn't savings in the traditional sense. It's money typically earmarked for investment, so on the way in or on the way out, or waiting for an opportunity to invest. However, it is a really big pile of money, and it doesn't earn clients much interest in the current setup. And at the time, we didn't really have many alternatives for this cash. So initially, we were thinking, how do we better serve this cash? And once we started looking into it, and talking to clients, it became quite apparent that many HR clients were holding significant balances in their current accounts, in high street bank savings accounts. There was also a significant group of them actively managing their savings across multiple banks and building societies. So that really got us thinking there must be a better way for clients to manage this cash, both for those not earning much on the high street and those managing accounts across multiple providers. And there really hadn't been a great deal of innovation in this space for a number of years. I think that there were a few small cash platforms around at the time, but no big names. And then we had the around about the same time, the FCA released that 2015 cash market study, which really highlighted the structural issues in the savings market around things like transparency, customer apathy, low switching volumes. I think that report really galvanized us and confirmed to us that we were along the right path, and we were building something that was going to be genuinely useful to customers and ultimately to banks. So it's really a similar story to HL trying to get customers a better deal by driving changes in the investment industry 30 years ago. We asked ourselves, why isn't managing a portfolio of savings as easy as it is managing a portfolio of investments? So we set about building a service that addressed those issues.
You've been involved with the company for quite some time, as well as been involved in active savings. So tell us a bit about your background.
I think I've been there 10 years, 3 months, and 15 odd days, I'm not counting. HL was my first proper employer after leaving university. I mean, I'd rebelled against the rat race a bit initially, and I actually headed out to America to work as a skydive instructor on a mobile wind tunnel, of all things. So we travelled all over the US teaching college students how to skydive, which was a lot of fun. Wasn't really a long-term thing, and I think it felt like I was avoiding getting stuck into a career. So I came back to the UK.
Skydiving to cash savings is some pathway.
Quite a leap, if you excuse the pun.
Yeah.
So I came back to the UK, ended up taking a job at HL on one of their telephone teams during the kind of busy end of the tax year season when they traditionally draw in a lot of people. Really a fantastic introduction to retail financial services and a great way to get to know that company and its customers. I mean, I still remember my first phone call after I'd finished the training, and I think the client could sense that I was quite fresh, gave me a really hard time. I think
oh no,
it was actually fairly brutal. It nearly kind of borderline in tears afterwards. But I think I probably learned more in that first 6 months working there than my entire 3 years at university. So I was so happy to be learning. So I set about working my way up the ladder, had some reasonable successes. Shortly after the Royal Mail IPO in 2013, I actually took over running the investment help desk. So that's the team of lovely people you end up speaking to when you call the main HL number. By the end of my time there, I was running a desk of maybe 100 or so people, mostly of a similar age to me. And whilst I enjoyed that challenge, I'm not sure the job actually suited me that well. I'd sat exams to become a financial advisor, but that didn't really appeal to me either. I think ultimately I enjoyed problem solving and creating things. So when the opportunity to help start a new savings business came around, I grabbed it with both hands. So I met my current boss, Stu. he's been involved in setting up new businesses for HL before and had this kind of entrepreneurial reputation. And after meeting him, I just thought, yep, this is a person I want to work for. He ended up splitting the role in two, hiring another guy called Dave Chapman. So we worked together really well from the off. Actually ended up becoming really great friends, probably to the point where we finish each other's sentences. He's exceptionally good at his job. I mean, he's the brains behind the operation, and in fact, probably the brawn. He does all the heavy lifting. I just get rolled out for award dinners and podcasts. When we started, the idea was still really conceptual at HL. Yeah. So I mean, at that point, it wasn't a great deal more than a few doodles on an A3 piece of paper. But those early days were a lot of fun. It was like working for a startup, but with the backing of a FTSE 100 company. So you weren't worried about getting paid at the end of the month.
Yeah.
I mean, there's a really big team of really great people involved in active savings now, and it's been an awesome project to work on. We've been building the platform for 6 years. We've been live for roughly 2 years. So, on top of building new products and features, we now have the very different challenges of running and scaling up a live business.
Let's talk about that a bit more then. So, talk to us about why should a saver go direct to active savings rather than go direct to the bank or go via a price comparison site or savings information, personal finance blog, that sort of thing. Why active savings?
Active savings offers a simple, convenient platform to manage your savings without ever having to physically or digitally go to another bank. So through a single HL login, you can manage any amount of savings in any number of products across a range of different banks and building societies. So whether you're building a fixed-term bond ladder, spreading money across FSCS limits, or structuring a savings portfolio, active savings just completely takes away that hassle. And you can do all of this alongside any of your other existing HL products if you have them. And it's easy to move money between them. So the interest rates are as good as you'd get directly from the bank for the same product. And the banks we partner with typically pay competitive rates. And I knew you'd ask a question like this, so I checked the data this morning. We've had at least one market-leading rate for 85% of the last 18 months. And the rest are typically top decile or top quartile.
Yeah.
I think
that's quite good. That's quite a strong stat.
We never expected that in the beginning when we were building it. So yeah, a bit of a result. I think comparison sites are a mixed bag. They definitely make browsing and selecting products much simpler. But I don't think they make managing your savings any easier. They also assume that rate is the only important thing when selecting a product, which we know, as we all know, isn't always true. You still then have to click through to the bank's website and apply. This means forms to fill out, anti-money laundering procedures to go through. You have to give your data to and deal with multiple entities. After that, you've got to maintain different logins, remember to consolidate it all at tax year end. If you're managing more than 3 accounts, it's a bit of a pain. And some people really don't mind doing that. If you're willing to devote a Sunday every month to keeping on top of it all, great. I think most people would probably rather have the time back.
You're absolutely right. I'm always quite shocked by how sometimes they almost speak to savers. It's like a badge of honour how many bank accounts that they've got. They kind of really enjoy it.
I think it turns into a hobby, doesn't
it? I think it does actually for some. I think it's. I think it is that, and they almost become interested in quite how they all operate and why and the differences. But yeah, I think you're right. I think they aren't the majority. So talk us through about give us a sense of the size then. So it's quite an attractive proposition for a saver. There's a lot that's cut out. And we appreciate your listed company, so you can't divulge in confidential information because there's quite strict rules around what you do. But share what you can. Bring it to life for us.
The latest I'm allowed to give you is half year numbers. So that's financial year. So 31st of December. At that point, we had roughly 2.9 billion deposits under management and more than 50,000 active users. So at that point, we were brokering about £500 million a month. So that was off the back of kind of NS&I cutting rates late last year. So yeah, quite a busy couple of months for us at the end of last year. There's 13 banks on the platform at the moment. 12 banks and one building society. The platform acts like a marketplace, so the product set changes all the time. But there's typically between 20 and 35 products available, and it's either easy access or fixed term at the moment. And the number of banks and products available will continue to grow over time.
It's a growing marketplace, isn't it? There's been a number of platforms, marketplaces, call them what you will. Regulators like deposit aggregators at the moment, although no one else really kind of uses that terminology. But there's a lot good there for savers in terms of one log on, access to some market leading exclusive rates sometimes. Overall, though, the kind of sector accounts for certainly less than 1% of the market overall. What do you think some of the reasons are why we've yet to see them make a bigger impact in the space?
I'd be surprised if it was 1%. I worked out the other day that we represented 1% of the fixed term deposit market, but 0.2 or something, or 0.15 of the whole market. I mean, I think there's a few things going on. Firstly, the savings market is huge. There's something like 1.7 trillion of deposits held by UK households. So, while savings platforms have been growing really fast in their own right, we're all still pretty small in the grand scheme of things. Secondly, I think savings market is still incredibly concentrated. As a nation, we hold something like 2/3 of our savings in high street banks. Most of us with the bank we have a current account with, and again, for many of us, it's the current account we opened when we were 18. There's an awful lot of apathy and inertia when it comes to savings. I remember hearing a fact a few years ago that I think statistically you're more likely to get divorced than change bank.
Yeah.
And psychologically, savings are often associated with a feeling of security and safety. It's our liquidity buffer or rainy day money. So I think this means decisions about savings are often driven by emotion on some level. And I think for this reason, people generally like to feel that their savings are close enough to be accessed quickly. So what this means in practice is that proximity to your current account. And the current account provider is likely to be a high street bank, so much of our savings end up in these savings accounts. And the ironic bit is these banks don't want them. Ring fencing has left them awash with deposits. So today they pay nothing, 0 or 0.01%, which is nominally positive, but a negative real rate when considering inflation. So leaving large savings balances in accounts for the long term is almost a guaranteed way to lose spending power over time. And I think lastly, generally awareness of this kind of service is low. You and I are in the industry, these things are on our radar, we talk about them all the time, but for most people, they don't hear about it, or they probably don't care about things like savings platforms or open banking for that matter.
That's a really interesting point, isn't it? I think I kind of wrestle with this issue. You talked there about the kind of roughly 2/3, sort of 70%, somewhere around that level of savings still sat with the the main current account providers, and that despite the influx of new entrants over the last 10, 11 years, that still hasn't really changed significantly, percentage wise. And some of that's because the savings market is massive and has continued to grow. So actually, the growth each year is quite a bit to take care of. Yeah. But there is that bit and about why is it not moving quicker? I guess that on one hand I get frustrated, and then on the other hand I look at it and think, well, actually you've got Barclays, Lloyds, etc. They've been around for over 300 years. Why would a 300 plus 350 year monopoly be broken up by a few new entrants in over a 10-year period? It's going to take longer than that, isn't it? Probably.
That's it. I mean, I have a current account with Santander, and until recently, I've had some of my savings there, and I didn't move it because I didn't need to. I just need my current account. I need my card to make payments. I don't need bells and whistles.
Yeah,
just need it to work.
That is the challenge. That I it's the stat you mentioned now on divorce and switching your bank account is something I'd like to look at in light of the current account switching service. Whether that's actually changed more recently now. There's a little bit more volume going through.
I think it's a few years old, that stat.
Yeah, but it does highlight it is. You and I both come across plenty of people who've had the same current account for 35, 40 years. We're talking about sort of other sort of platforms and marketplaces. We've obviously seen Octopus Cash close its doors to new customers. I mean, they've cited in the current sort of interest rate environment where they they took a percentage of the return, that was no longer viable because they couldn't see the market changing and interest rates rising in any time in the future. Do you think we'll see others follow out of the market? And if so, do you think that is that a good thing that maybe we see a few stronger and more successful players remain? How do you see it going? Where do you see that?
I think the commercial environment is really tough. I think clearly a business model that is reducing the economic return of a product to the customer by more than a third is going to struggle in this market. At HL, we've tried in the past having a model where there was a 25 basis point fee taken out of the rate, and in our experience, it just didn't work that well. That's why now we aim to ensure Active Savings offers rates that are as good as the bank's own rates. I think as well that the cost of acquiring customers and growing a business is always considerably higher than anyone anticipates. It's not quite a case of if you build it, they will come. You need to marry a great idea with great distribution. And this is probably why the partnership model is so popular, as we've seen with other savings platforms. And I think this environment will force these platforms to innovate and to do so in a way that is very lean and keeps costs low. You can't build a business with a route to profitability that only works on the basis that interest rates may be higher one day. If you can't make it work in this environment, you probably have to exit. There's a few core players now. I don't think they're going to disappear. I think most of the new entrants will probably come through partnerships with those existing savings platforms rather than completely new businesses. As we found out ourselves, building this thing from scratch on your own is not easy. However, that partnership model puts more pressure on the need for higher fees, as there's more mouths to feed, which in turn makes it harder to attract customers and banks. So commercial environment's tough for the moment.
That's an interesting point. I agree with you. I think everything that I'm seeing sort of lends itself to. We'll probably see more players come into the space, but it will be partnering with people who are already providing the platforms rather than putting that effectively, arguably overlaying a stronger brand on an existing platform to try and cut through. But as you said, then that means more mouths to feed. So someone's got to pick up the tab for that somewhere along the line. So certainly going to be an interesting space to see how it develops over the next sort of few years. Talking of which, what are your plans? Where are you going in the future? What can savers expect to see from Hargreaves Lansdown in terms of product, services, etc. in the pipeline?
We have fairly quietly launched a cash ISA. It is the first iteration, so at the moment it's new ISA subscriptions only, and it's just one easy access product from Coventry Building Society.
Yeah.
Over time, plan is to broaden this out to include more products, more banks, include transfers in. A multi-bank, multi-product kind of portfolio cash ISA like this hasn't been done yet. I think it's going to be pretty cool once we get that live. Other things, we're currently building a maturity process, so you can provide rollover instructions ahead of the maturity date. We're kind of pushing out the default product feature. So that's something that lets you set up a rule. So any dormant savings in your hub account kind of get automatically swept into an easy access product to make sure it keeps earning interest. And there's loads of other stuff in the roadmap, like notice accounts, regular savings, better payments infrastructure, more tools and features to help you save. I think we'll be busy for some time yet. And as we mentioned earlier, the general awareness of the service is low, even amongst HL's own client base. So we'll be putting in a considerable amount of effort into spreading the message about this kind of, in our opinion, great way to manage your savings.
Yeah. We've seen a massive influx of new entrants. We've kind of talked about over the last sort of 10, 11 years. So Cash Plus is now the latest to be authorised, which is number 32 since 2010. But we've seen other players, kind of already licensed banks, come into the savings space that weren't previously there as well. How does that impact on platforms and marketplaces?
I look after the bank side of the platform day to day. So we are a platform for banks as much as we are for the customer. And the way I often position the platform to smaller banks is as a way to help them attract deposits out of the high street banks, rather than shuffling deposits around each other. I think the benefits of this are multifaceted. So the client gets to earn up to 50 times more interest in some cases in an FSCS protected account. And those smaller banks that actually want the funding can continue to increase their lending and get that money recycled back out into the economy. For these smaller banks, platforms can offer a way to plug into a digital savings platform with an existing audience of depositors for a relatively low cost. Helps with distribution, cost of funding, operational resilience, etc. So I think more new banks entering the market likely gives platforms like ours more choice of product providers, more capacity to grow. I don't really like the term challenger bank. I think it's used very liberally, but a greater number of smaller banks may mean that more competition is introduced into the market, and we start to see that dominance of high street banks starting to get eroded over time.
Yeah, I'm not a fan of the challenger label. It's been used far too widely, hasn't it?
Anyone who's not a high street bank, apparently, challenger bank.
Yeah, pretty much. Well, I mean, we're talking about how much the market has changed in a lot of ways over the past decade. What about going forward? Where do you see the space moving in the next few years? What do you think the savings market's going to look like in sort of 5-10 years from now?
It's a good question. I guess I'll turn to the data first. So over the last decade or so, I think household deposits grew by, 600 billion, some crazy number. But I think the real story has been in the change in how we save over that period. So easy access has more than doubled, fixed term has halved in the same time. Easy access is now 80% of the market, and I think it's easy to see why. 10 years ago, the average reward for using a 12-month fix over the average easy access rate was more than 2.3%. So that was the uplift you'd get. Today, it's less than 0.2% on average.
Yeah.
So savers are just not rewarded for fixing for longer terms at the moment. So I think we'll see a continuation of this trend. Quantitative easing continues to flatten the yield curve, keeping term rates lower. So I think in these conditions, customers will prioritize access to money rather than getting a small uplift in yield for locking it up. And easy access under the right conditions also, for a bank, attracts quite attractive liquidity treatment under the current regulations. So I think banks will continue to use it as a source of funding fairly liberally. It's kind of other trends. I think this one's an obvious point, but I think we'll see the channel people use to save continue to shift towards online and away from postal and branch, which baffles me still surprisingly represents a really big volume. But I think the pandemic's likely to have moved this on 7 or 8 years up that adoption curve in the space of 12 months. So even more people doing kind of online banking now. I think this will make things tough for smaller banks and building societies that have probably to date relied quite heavily on their branch and postal channels for deposits. I think savings platforms will continue to grow. slightly biased in that view, but will continue to develop their propositions, become more widely accepted. I think we're likely to see more services arrive that are facilitated by open banking and open finance. I do think the increasing portability of savings clashes somewhat with the bank's kind of general requirement for stable deposits. So it's going to be really interesting to see how that develops. On the one hand, you've got the FCA calling for more competition and more switching in savings. On the other hand, banks must run a deposit stable book, and they're penalised if they don't. So I think banks are stuck between a rock and a hard place a little bit here.
Yeah.
But if we see lower rates for longer, I suspect we'll see more banks trying to innovate with features other than interest rates. So, it's still quite niche, but I think we'll see more things like green deposits, so where they plant trees or offset carbon footprints. I think that will become more popular as time goes on.
That's an interesting point. I think we'll see more of that too as well, because I can't see the drivers for rates increasing significantly from where we're at any time soon. So I think it will create a kind of more emotive route like social responsibility or environmental that might attract savers to kind of support them.
Maybe more products that look a bit like premium bonds, that lottery idea. I suspect that'll probably become a bit more popular as well.
I think that the challenge there is that it's so sewn up by national savings, isn't it? They have such a strong advantage that it's very difficult for them to be taken on, and it's arguably the nation's favourite savings product, isn't it? Now you've got over 105 billion invested in premium bonds, and it's growing strongly by $1 billion a month over the last few months. So there's no sign of that appetite waning there. I think you're right. I think we will see more of that kind of. I think that's harder for the smaller banks to launch, because it needs scale to generate the prizes, which is what they lack by their nature in the early days. The one question I ask everyone, which you've kind of teed me up quite nicely for there, is if you were the Chancellor for the day, what's the change that you would make that you think would bring the biggest benefit to savers?
This is an easy one, and you've probably heard this before, but I'd simplify ISAs. Stocks and shares, cash, help to buy, lifetime, innovative, junior. It's becoming complicated. I'd like to see them consolidated somehow. I've had the privilege of working for a financial services company for a decade, so to me it's easy to navigate through all of this. But lots of my friends who don't work in the industry just do not save efficiently for their future, and it's often because it's daunting and complicated rather than a lack of will or simply having the means to put money aside. If one of the things the pandemic has shown us is the importance of financial resilience. You don't have to put away a lot to start building that buffer. The secret ingredients are just time and patience. And as a result of a multitude of different forces at play, it feels like much of my generation is slowly sleepwalking into a bit of a savings and retirement crisis. We simply won't have enough money in old age, and we'll be working well into our 70s. And that's if the robots haven't already taken our jobs. But I'm a millennial, and I dread to think of the cost of avocado toast in 2050. Should be able to afford it. But in summary, I would back anything that makes it simpler for everyone to save and invest with confidence.
I think that that's something that we strongly advocated for a while. I think sadly the pandemic is definitely removing any chance of that happening anytime. Understandably, other things that are taking up the Treasury's time at the moment, but that will be something that they will look at too. Because I agree with you, and sadly, I am old enough to remember Tessers and Peps, and a big part of bringing in ISAs was their simplicity, and I think they did a brilliant job initially, and some of the changes over the years to make them even simpler have been really, really positive. But the Cameron Osborne administration started to tinker around sort of 2015, 2016 with it, and that simplicity is now gone. Yeah, we've almost got an ISA for every day of the week.
Yeah, it's something we talk about a lot back in Bristol HQ.
It's certainly something I hope will get addressed. And there's been some decent proposals put forward that could work. So we're going to have to wait for next year's budget, I think, at the earliest for that. But let's hope. One thing we've talked about COVID a little bit, and you mentioned it about the digital adoption, and it's I keep seeing the little meme doing the round of what's driven digital adoption most, the chief technology officer, the chief financial officer, or COVID-19, and obviously COVID has had a massive impact on digital adoption. You sort of talked there about sort of 6-7 years forward. I've seen people talk about it's move things on by a decade. What's your kind of thoughts on that? Do you think we will see that kind of continuing to accelerate, or do you think we're going to end up with a significant minority that kind of still want that kind of branch postal high touch point service, and how do we get around that?
It's an interesting question. I think as we emerge and hopefully kind of head back into a normal world, I think that adoption will probably slow. I think there will be a rump of people who just steadfastly refuse to entertain the ideas of iPhones and computers, and we'll take their passbook into the branch and we'll do it until the day they die. So I think there will be that rump of business will continue for some time yet. But I think it'll now be a minority. I think we'll be emerging into much different markets now, where much more, many more people are comfortable doing everything online. My parents wouldn't have bothered before. Now they're zooming around, getting shopping delivered online, getting their groceries delivered, online banking, everything, and they're more than comfortable with it.
Yeah, I've certainly seen that too. I think it's interesting. I'd say a lot of the banks are kind of trying to force that along by closing off branches is increased closure. I think some of that's definitely because the need for them is going to be less, but I think some of that's also opportunity to jump on the bandwagon and use that as a chance to accelerate things. But it's going to be fascinating. But I hope from a savings platform, the marketplace, hopefully that will be something that's positive in terms of that digital adoption.
Yeah, I mean, we've talked about how at the moment Active Savings is online only. There's a couple of things we can do over the phone, but it's an online only service. We've talked at length. Can we create a version that works over the phone and through the post? And it's quite difficult because of the nature of that marketplace model. We could send someone some rate card in the post that would have all of the products available. By the time they've looked at it and come back to us with some choices, things will have moved on a bit.
Yeah.
And the rates might not be there anymore.
Yeah, it's something that'd be very tricky, wouldn't it, to do that way? Well, it's been a fascinating conversation. I've really enjoyed it. I think our listeners will certainly learn a lot more about savings platforms. So thank you very much for coming on and talking to us, Tom. It's been really interesting.
No, thank you for having me. It's been a pleasure. Anytime.